Hello, everyone. My name is Greg Munroe. I'm the founder and CEO of Morrow Wealth Management. I'm joined by my partner and senior wealth advisor, John Coughlin. And what we wanted to do today was get right into one of the questions that a lot of our clients have. In a high inflation period like we're in now, and if it ends up being a consistently high inflation period, how do stocks in real estate perform historically during periods of high inflation? That's what we want to get into today. We want to give you a little historical perspective of how these assets perform during these periods of high inflation and what that might mean for you as we look forward.
So making sense of all these terms that you're hearing about inflation, stagflation, deflation, and obviously recession is a big one right now. So inflation, I think everybody's kind of on board with what that means after this year, is just the rising costs of goods and services over time. Deflation is the opposite of that, so falling costs of goods and services. Stagflation is something that you're probably hearing a little bit about right now. That went on a lot during the 1970s. So that is a period of slowing economic growth, high unemployment, and high inflation. So it's kind of in contrast to what we're seeing right now. And then obviously recession. There's a lot of different definitions out there right now. I don't think anybody's too clear on exactly what that is, but that is the slowing of the economy, rising unemployment and falling profits. So those four definitions might help make sense of all this and how it plays out into your investments today.
The reason why inflation is so insidious is it reduces your purchasing power over time. And that's why the Federal Reserve is so adamant that it's going to kill inflation no matter what. You can see here from this chart, I've been doing this almost 30 years now. And you can see from the chart where it starts off at 100, where you had $100. If you go out 30 years, and my career is a good example of that. If you look at the inflation rates in the 3 and 4% range over my career, your purchasing power has been more than cut in half. Let me give you a real life example of that. That means that my clients that are in retirement and have been retired for 30 years, let's say they needed $100,000 a year to live off of in 1992 when I started. Right now, they need $200,000 a year or more to have it feel like $100,000, because over these 30 years, just at 3.5% inflation, which is roughly what the inflation rate has been over these 30 years, your purchasing power gets cut by more than in half. So all the more reason why you need to understand what happens during an inflationary period and how you position your assets to perform for you during this time. So now that we know about why inflation is so insidious and why we need to stop it because it destroys your purchasing power, the next thing a lot of economists are talking about, or you hear a lot about, is that the last time inflation was really bad was during the 70s, and you had that stagflation that John had talked about, where you had high unemployment, high inflation, low economic growth. So we thought it would be helpful for you to look and see what actually happened during that time frame. So you can see there, yeah, thanks, John. When from 1973 to 1981, just look at that next column. That's what the inflation rate ran at year by year. Huge, high inflation consistently during that 8-year period. Really, really tough, 9.3% at average. Right now, here in 2022, we're at 8.4, and just with the recent inflation reports, we're down to about 7.7. What's different about this time frame, unlike the 70s, is if you look to the next column there, the unemployment rate during the 70s was quite high. It was in the 6s and 7s. It averaged almost 7% per year. We're coming into this period of inflation with very low unemployment, only down at 3.7%. That bodes well that maybe we can avoid an inflation, a recession here, because you have so many people at work in a very tight labor market. So that's kind of good news for us compared to the 1970s. The other big thing to keep in mind during the 1970s was how high rates were on treasury bills or on bonds or your borrowing costs. Back then, you can see here the 10-year treasury bill, which is the risk-free rate of return. It was getting you 6, 7, 8%, and it averaged 9% per year during that period. Remember, folks, higher interest rates are like gravity on your investments. They pull down the value of your investments because it costs more to borrow and your profits get hurt by higher interest rates. What's nice about right now is the 10-year treasury bill currently, as we record this, is 3.8, but during the course of this year, it's been averaging about 2.6%. So again, we're very lucky. We're coming from a very low inflation rate, low interest rate environment to a more moderate interest rate environment. And many of us think that soon that'll be moderating. So we don't think this is like the 70s where you had high unemployment, very high rates and borrowing costs. This seems like a more moderate period, which should bode well for your investments. Now, what we wanted to show you next, and Jon is going to talk about this, is we want to show you that even during a horrible period, the 1970s, we had stagflation. We think you're going to be surprised by how stocks did during that period. I'm going to have Jon talk with you about that.
Thanks, Greg. So going off of what Greg was just talking about, during that period of time where they had really, really high inflation and they had stagflation because they had high unemployment as well and low economic growth, they had some tough years in there. Absolutely. 1974, you had inflation 11%. The S&P 500 got crushed. That recession lasted from 73 to 75. But what we thought was pretty interesting here, 73 was another bad year, down 14%, inflation at 6%. What we thought was really interesting in here was 75, you have these years of 9% inflation, and this is still during a recession. You have a 37% up year for the S&P 500 that year. So that's in the last year of the recession with really, really high inflation still at that time, also stagflation. The economy's in a weak spot. We're in a much stronger economy at this point in time right now with low unemployment. But you have these huge years in the stock market. You obviously have a tough couple of years going into that, but on the back end of this, stuff really starts to look pretty awesome to be an investor in the stock market. 23, almost 24% in 1976. Inflation's still running pretty high. So you just see this absolute whip back at the tail end of that recession. And we actually think the US economy is in a much stronger place than when it was back in the mid 70s. And then what's also really interesting about this, we thought, is that inflation running really, really high here. This is a little bit of an outlier, but 1947, 14% inflation, the S&P 500 was still up 5%. And then getting back to what we were talking about in the early 80s, 13.6% inflation, really, really high inflation. The market does really well there. 1979, same thing, 11% inflation, 18% return on the S&P 500. So main takeaways here are that, one, we don't think this is anything like the 1970s. We think it's a lot different. But even during that time, the stock market still managed to average 5.2%, which we think was pretty unbelievable for a period of really, really tough economic times. High unemployment, high inflation, a lot of geopolitical stuff going on in the earlier part of that decade. And from 73 to 81, the S&P 500 averaged 5.2% per year, which is a pretty solid return for being a stock investor. So not impossible here. And we actually might think that things turn out a little bit better because the economy is in a stronger place. Greg, I don't know if you have anything to add on that, but I can go to the next one.
No, nothing extra to add on that. You nailed it.
And then talking about other asset classes that tend to perform well during inflationary times. So you can see on these two top charts here, you have a high growth and high inflation period and a low growth, high inflation period. This top one here, the low growth, high inflation, is similar to what we're experiencing right now. And as you can see, real estate tends to do really well during this type of environment. You can kind of think about how corporations can pass on increase in cost to the consumer and maintain profit margins by doing that. Landlords can do the same thing with real estate, passing on increased cost to them, borrowing costs or their overall costs that are going up, and pass those on to tenants through increased rents. And that causes real estate to go up. You're getting a higher rental value on these properties, whether they're commercial or residential. So real estate tends to perform really well during inflationary periods. Stocks are still also a good place to go, but real estate is really the outlier here that does really, really well during high inflation periods. Thank you for joining us. Like I said, I'm Jon Coughlin. I'm joined by Greg Munroe.
Thank you all for joining us. We appreciate it. If you're an existing client, we hope this was helpful and a little educational. If you're not a client, you'd like to potentially become one or talk with us, we encourage you to take some action. Either give us a call or you can email us. and we'd be happy to give you a complimentary consultation to see if we can help you become financially strong, financially confident, so that you reach your financial goals, which is the most important thing. So thank you very much for joining us, and we'll talk with you again soon.